Hello, hello, hello. Here again with Thomas. How you doing, Thomas?
I'm doing
Thomas
well,
is
thank you,
shaking
Brett.
his head yes for those who can't
Of
see us.
course.
This is Brett. We're here, Real Estate Mogul MD. Welcome to another podcast episode here. We are blessed with the opportunity to speak with Parker, Garrick, and David, fellas from Capital Impact. Fellas, how you doing today?
We're awesome,
All at
gentlemen.
once,
Thank
they
you.
say.
Wow.
There they are. There they are. So, hey guys, I'm excited to start drilling you guys with questions, and I also have the opportunity to meet with you guys once a week and run through this stuff. But today I just want to talk about a couple of topics that are fresh on my mind, and just the opportunity I think is ripe for the picking. One of them is velocity banking, and the other one is leveraging insurance. So what I would love to do is just jump right into this thing and talk about leveraging insurance. And why I want to talk about this is my wife has a permanent life insurance policy, and through our entrepreneurial journey and investing in real estate, flipping houses, we stumbled across the opportunity that we could actually borrow money from our permanent life insurance. And uh, at that time, it was a blessing because we implemented right in one of our flips and made some improvements on a property. Ended up selling the property, paid the policy back, but during that time, we learned that I think we paid ourselves interest during that. So we borrowed from ourselves and paid ourselves interest. And I just think there's a whole world of opportunity there. And Parker, I know that you are experienced in this. So if you just want to start by telling me a little bit about your experience with the insurance leveraging and how you stumbled into it. And then I want to drill you with some more questions on what that really looks like for real estate investors and people out there who actually have access to this capital.
Yeah, so I've been doing this for a little over a decade now. Uh, it's kind of funny how I stumbled on it, actually, because the house that I grew up in, my dad was gone for 3 days, Texas to do a seminar, back for a couple days, and then he was in China for a week, and then back for a couple days, and then he would go to Florida, right? So he was traveling all over the world, teaching seminars on investing, and this is back when the internet was first coming out, and had done a lot of different things since then. This was his big acquisition that he had from TD Ameritrade when they got bought out, and then started a new company teaching people how to trade options. And even to this day, 20 something years later, he still tells me his full-time job is opening up a couple trades on Monday and closing them out on Friday afternoon, amongst the other things that he's done. So for me to grow up in a house like that, where I was getting up at 5 a.m. to learn how to trade futures with dad as a young teenager, it's kind of funny that we stumbled on this insurance thing, because most people, especially from the investment world, kind of poo-poo on insurance because it's high cost. There's lots of fees and commissions. Your money's not going to grow. It's hardly earning any interest. You can do much better in the market, right? But that's not really the point of why we do these insurance plans, the way that we structure and design them. It is a component of it. The rate of return and the growth is important, but that's only one aspect of why we funnel money inside of this bucket, if you will. And so earlier on, my college savings from delivering pizzas and mowing lawns, instead of going to pay for school, instead went into life insurance, a high cash value structured whole life insurance policy. And while I was going to school, instead of whatever money I was making and saving, going towards paying for school and costs, instead just got all funneled into the insurance. And by doing that, I didn't have to put that asset, which it is an asset, on the FAFSA applications when you're doing college administration and things like that, or admissions. And so on paper, I actually looked really poor. And this helped me get grant money, scholarships, student aid, and 0% interest for, Stafford loans for covering the gap that grants and whatnot didn't cover. So the actual cost of college went down pretty significantly for me because none of this money looked like it was available or even reportable. Conversely, it's 100%, on paper and counts as an asset when we're looking at things like real estate or trying to get a mortgage, which is great. So it counts when it makes sense and doesn't count against us for things like college. And so the little amount of money that I did borrow for the actual cost of college, when I was done with school, all of that money was built up inside of my policy, and I could just basically refinance the debt from my policy. But the secret sauce is that all of my college savings was still growing and earning uninterrupted compounding interest while I used it to pay for school at the same time. So it's this whole idea of using your money in two different places at the same time, or kind of double dipping. And this would be one of the core uses of these types of plans is financing large capital expenditures.
Let me interrupt you right there, Parker. So on this direction, so you put this money into a whole life insurance, what I'm calling like permanent life insurance. So it has cash
Correct.
value. It's showing as an asset. So say you had $20,000 in there. And what you're doing is you put it in there so it doesn't show up on these other forms, FAFSA, all this other stuff. But then you're borrowing it back out of there. You're scooping it back out of there. And then you're paying for books, you're paying for classes, and it's borrowed out of that account. And there's an interest that's bearing while you're got it borrowed, right? So I took of that 20,000, say I took 10,000 out and I paid for my classes. Do I have to make do I have to make like monthly payments to that? Is that how that interest is paid?
You can, but you don't have to. It's a simple interest calculation on the loan. Obviously, if you don't pay interest on the loan, it will add to it. So you could just pay interest, or you could pay a certain monthly payment. But the difference between a life insurance loan and a traditional loan is that it's an unstructured loan. So how and when you choose to pay it back is completely up to you, or even if you ever pay it back, because it is collateralized against the permanent death benefit that is guaranteed to pay out at some future date, because you will eventually die, in case anyone didn't know that.
And so you say, yes, the simple interest, then is that like 3%, or what is that? Because that's your actual rate of return then, right? This interest?
Not necessarily. So there's, and just to clear one thing up too, I know you talked about taking the money out to pay for books and tuition and things like that. So I actually wasn't using any of the money in the life insurance. All the money that I was still earning or could save got funneled into the insurance, and whatever cost of college wasn't covered by grants or scholarships and student aid was covered by 0% interest-free loans until after 6 months of graduation. So by the time I was all the way done with school and I had a few Stafford loans that didn't have any interest, I just then borrowed the money against my life insurance and paid off those loans before I had any payments or interest due on them.
Okay. I see. And then while
then
you
I
had
can
that
be in
money
control of how and when I actually pay those loans back, but back into my policy. But all that money, instead of paying interest to Sallie Mae or Freddie Mac, I was earning uninterrupted compounding interest on.
Right. And that
so there's a couple.
Yeah, go ahead.
No, you go ahead.
So that interest that you were earning, do you have, is just hypothetically speaking, is it like 1%, 2%, 3%? Where would you expect to see that type of interest on a whole policy like that?
Yeah. So again, we're not trying to beat the market here, right? We're trading risk and uncertainty for guarantees and predictability. But it is still a reasonable rate, especially with where rates have been lately. I know they're on the rise here. But depending on the company and the product and how that product was designed or customized, you're probably going to do 4, 5, maybe 6%. And with rates going up, we'll probably see some of these dividends go up on plans. But the dividends are broken up into a couple different chunks. There is a minimum contractually guaranteed interest rate. Right now, those are anywhere between 2 to 4%. They were 4% until last year when Congress passed a new law that changed the Section 7702 that defined a life insurance contract, where every policy before was based on a 4% minimum guarantee. However, now the minimum guarantee required is 2%. So companies had a little more wiggle room with what they could remove from their safe assets or liquidity to provide such a high guarantee and maybe roll the dice a little bit more. So nowadays, if you did a policy, you'll see a guaranteed interest rate somewhere in that 2 to 3%, and some are in the mid to high 3% range. Okay. But then there's the non-guaranteed portion of that, and that's where the dividend comes into play. So let's say, for example, the dividend that one of these companies declares, and again, there's the whole checklist that we want to make sure that this company marks off. Some of the basic ones would be a mutual dividend paying whole life insurance carrier that's been in business for 100, 150 years plus. So some of the top companies that we use or recommend are 163, 175 years old, been around a lot longer than even banks themselves have been around, and have a lot more in assets and liquidity. Some of these guys even than the federal government does to pay their promises. And so the non-guaranteed portion, which they always say is not guaranteed, but by these companies has been paid consecutively for 150 years, 160 years, every single year through, think of all the things that have happened over the last 100 years, and they've consistently paid.
Does that non-guarantee fit the gap between, you said when we first started, 4 to 4, 5, 6% interest?
Yeah. So think of that as like the total,
cover the
right?
gap. Yeah. Between the minimum guarantee and non-guarantee.
Let's say I'm the insurance company. I say that, hey, we had a good year. We're going to pay out 6% this year. 3% of that might be the guaranteed. The other 3% might be the non-guaranteed portion.
Okay. So help me understand then, if I've got that 20,000, I borrowed 10,000 to pay down the Stafford loan or whatever before, in your situation, before the actual payments came, the interest came, that kind of stuff. Of that 10,000 I have out, the simple interest that's being charged that I'm actually earning, say it is that 6%. That 6% fluctuates, but it's likely that that is actually my return. The interest I'm paying, I'm borrowing the money to myself, is actually what I'm collecting as a return.
Yeah. So this is where some of the secret sauce is. So one, obviously we want to have some arbitrage, right? And I imagine most of your well-educated listeners know what that means, right?
Mm-hmm. The difference, just in case everybody's as smart as I am, it's the difference between one point and another, right? It's that spread, the arbitrage.
Yeah. I buy something for $1 and I sell it for $2.
Yes.
So in most cases, or at least preferred, again, this is where company and policy and structure are paramount. You might be paying 4 or 5% in interest on the loan, but you may be earning 5 or 6% compounded on the cash value. But here's where the secret sauce is. Even if you are earning roughly the same rate as what you're paying in interest, let's say I'm getting 5 and I'm paying 5 on the loans, well, then it's a wash, right? Not necessarily. If you go and do the math on whatever loan amount, let's say you take out $100,000, and if you earned 5% compounded interest over, let's say 30 years versus paying 5% simple interest over, like, let's say an amortization schedule, the reality is you're going to pay a lot less in actual interest than what you're going to earn in compounded interest. That makes sense.
One other thing, Brett, just to add to what Parker's saying, this is David, is you're paying the interest on the balance that you're borrowing. So if you're borrowing a fraction of what you have, you're earning on everything that's sitting in there, but you're only paying on the fraction that you've chosen to borrow. And so that's also another important factor to take into consideration.
Yes, the fraction of it. So the big difference I'm hearing is getting versus paying. The return is a compounding number, and what I'm actually paying to borrow from myself is a simple interest. And that difference is how the principal is built. and then how that interest is applied to that principal. Is that a fair way to describe the difference between compounding and simple
I've got
interest?
some pretty pictures that I've painted that if you're nice and, if I'm nice enough, I guess maybe you'll invite me back and we can do some actual numbers and look at some slides to illustrate this. I think it's pretty powerful to actually see the math behind it.
And that's kind of like touching on that other topic I wanted to run by you guys too, was the velocity banking. And that's kind of like leveraging a similar mechanism where we're attacking compounding by leveraging simple.
It's a little bit different on the velocity banking. I don't know if we'll get quite into that this time. Maybe we come back and circle on that.
I won't muddy the water up on that one. But the difference here, the return that we're looking at on our insurance is a compounding return. And then what we're actually paying or charging ourselves, the insurance company is charging us to borrow our money, is a simple interest. So the simple will not grow as fast as the compounding.
Correct. Yeah, which is why even if at some point I decide I want to borrow as much money against my policy as possible, if it's designed correctly with the right type of company, that won't be the last time I say that, the policy won't blow up. Mm-hmm. And you'll actually still be in a better position down the road if you keep the policy rather than just, oh, hey, I owe this much, but technically there's this much in the policy. Let's just cash it out so I don't have to worry about it.
There's some other points to anchor to this,
David.
Brett. Also, I think just worth adding in. So my background, I got introduced to this concept before I knew what it was. I didn't get a chance to leverage these skills that Parker did coming into it. So I had a policy before I even knew what it was. And then I started working for a family office where the comprehensiveness of finance was the primary focus for entrepreneurs and business owners. So that's where my knowledge started coming in around it. But the other factors to take in consideration, expert on this is Parker, but the other factors to consideration are this. When you're looking at it, you have to take in consideration the fact that there is what you're using the money for. If you are using the money for something that can earn greater than what you have sitting in there, that is another factor to take in consideration. Another is it's often protected against lawsuit, litigation, bankruptcy, and market changes if, to Parker's point, it's properly designed. So there are so many other ancillary benefits beyond just isolating this to simple and compound interest. If you look at your bank accounts, and everybody has a bank account, how likely are those protected against lawsuits, litigation, or market changes or bankruptcy, right? If you look at investments, I wouldn't consider this an investment per se. I would say this is an alternative way of saving rather than an investment. Although it still would constitute as an asset, it's an alternative way of saving. So when you're trying to decide what to invest in your guys' case, or like many of your audience, when they're trying to decide to invest into properties, this is a safe place in storing that cash where they have greater control of it with more sustainability than if they were to leave it in the traditional forms of maybe a traditional investment or a bank account. So I think there's a lot of ancillary benefits beyond just looking at simple and compounding interest, although that is a major winning factor.
Oh yeah, thanks for mentioning that. Those are absolutely huge, huge things just right out of the gate. Then I guess back to a hypothetical here, still trying to wrap my mind around the getting versus paying. So if there is no arbitrage, there's no difference, and I borrow this $10,000 and I'm being charged, I'm paying 5% for having this money out and a simple interest, right? So that 10,000 then is charged at 5%. But then what in the return, once it's paid back, then if I'm getting that 5%, really we're at a net zero there, right? So my account, my portfolio doesn't gain. Is that fair?
Yeah. So if you've got $20,000 out and you borrow 10 against it, you're getting charged interest on the 10, but you're still earning uninterrupted compounding on the 20. So as you pay that loan back, when you pay it back, it's as if the money never left and you never interrupted that compound interest curve.
So that's huge. No matter what I have borrowed out, that portfolio is still gaining as if it was there, still earning as if it was there.
Yeah. So one of the first concepts I always start when I'm talking with somebody or usually I'll ask them, did you know that you finance everything that you buy? And
what do you mean by that?
That's what usually people say, right? What do you mean by that? Well, what are the ways that you can pay for something?
You pay cash.
Finance.
There you go. Literally, there you go.
Yeah.
There's the two, right? We either save up our
Borrow
money.
it without them seeing it.
Yeah,
Oh,
we
that's
either save up our
stealing,
money and we pay cash, or we go into debt. The bank finances it, credit card company, whatever, and then we pay that back over time, usually with some form of structured payment, and then usually with some type of interest, right?
Mm-hmm.
And there's pros and cons to both. Most people would probably prefer cash. They would look at the debtor as probably the worst situation, right? I have to go into debt to get something, and then I pay it back, and then once it's paid back, I'm back to zero. I didn't really get anywhere. Whereas the saver has to first save up over time and build up the savings, but then when we go to purchase this thing, we've now depleted our savings, and again, we're back at zero, right? So when we introduce this concept and we instead funnel our money into the insurance contract first, this isn't a question of this or that. This is more of a question of this, then that. This is just adding another step to everything that we're already doing. So when we do that first and we funnel the money inside of a properly structured policy first and then leverage against it, the problem with going into debt would be that we have to pay somebody else interest, and we don't set the terms of usually how that money goes back to them. The problem with paying cash is that if that were in an interest-bearing account, we have now given up the opportunity to ever earn interest on those dollars ever again. Whereas when we use a policy, one, we're recapturing the interest we otherwise would have paid to the bank. And two, we're not interrupting the compound interest curve because technically we're using the insurance company's money and our money is still growing, compounding uninterrupted.
So
Right.
just to clarify, we're essentially what we're doing is creating our own bank to borrow from.
100%.
And I heard David mention cashing out, I believe. Was that you, Parker? So you can pull out the money that you have at some point if you want.
Yeah, there's two ways to access, well, I shouldn't say just two, but the two main ways you can access money from a policy. One would be through a withdraw, and life insurance works on a FIFO basis, first in, first out. And so anything that you pull out or withdraw of your policy above and beyond what you've contributed, which is what they call your basis, that's where you could have a 1099 or an income taxable event. So that would not be the preferred way, because when we actually withdraw and pull out the money of our contract, then we're not earning interest on that money. So the preferred way and how this whole system works is to take a loan from the insurance company with our cash serving as collateral for that loan. Because when we do that, how much on that last home that you purchased, how much taxes did you pay on that mortgage check that you got to purchase the home?
Let's just say 1,000.
Okay.
Well, you got taken advantage of then, Thomas. You paid taxes on your mortgage that you got. So
Not quite sure of tracking. What?
if you went and got a loan for your car, how much taxes did you pay on that loan?
I have no idea.
Hopefully nothing, because it's a loan. It's debt. It's not a capital gain, right? If I go get a loan for a $30,000 car, I'm not paying taxes on that $30,000.
Are paid
when I receive the money. Yeah. We're not talking about what happens after with interest and all that stuff. I'm just talking about, hey, if I need to go get a $300,000 mortgage, how much in tax do I pay on that $300,000 mortgage for that check?
I see what you're saying.
Right. Similar. Yes. When we do like a cash out refi, I pull more money than what I have into it. That arbitrage, that difference, is a debt. It's not a taxable scenario.
Exactly.
So even though I borrowed $20,000 more than what I had in there, it's new $20,000 to me, but it's shown as debt in the books. So there's no taxation. It's not a taxable event.
This is why the rich don't pay taxes.
Right.
Because they're not technically using their money. They're borrowing it.
And
even in the cases like you're talking about where we do a cash out refinance, we may have realized a profit, but we're not paying taxes on that because it's through a loan that we receive that money.
Right.
And we can rinse and repeat that process. So that's why that would be the preferred way, because obviously I'm not paying taxes on that money that I borrow against the policy. And again, how and when I choose to pay that back is totally up to me, or even if I ever pay it back. Because anytime I've got a loan against my policy, when I die, because this is a permanent life insurance contract, the death benefit will pay out. It will first pay off whatever I haven't paid back into the policy, and then the rest goes to my beneficiaries, kids, trust, charities, business, whatever.
So as far as an exit on something like this, say you've got $100,000 policy. So you've basically spent $100,000 to purchase this permanent policy, and something comes up and is like, hey, Parker, I need my cash. I need my cash. I need to put it somewhere. I don't want to borrow it. I just need it out. Then that is a taxable event to get that money back out of there. Is that what I'm hearing you say?
If we cashed out the policy and we've earned more than what we've paid into it at that point.
So it's the capital gains on the arbitrage, correct, basically. Okay.
Yep.
But it is absolutely possible. You could exit and say, hey, just give me my cash. I'm out. There's no fees or penalties or anything like that?
Yeah, it's going to be more of a case-by-case basis, but I would almost never recommend that, to just cash out and walk away. Because why would you do that if you can borrow it tax-free, not pay any taxes on the gains, and use that money however you want, and still earn interest on all that money that you just cashed out?
Absolutely. I asked that question because I like to run to both sides, all sides of the room, and figure out, hey, I can go here, I can go here.
Yeah, 100%.
Yeah.
Yeah, I get that whole, I want to take my money and run to the hills, right?
Right.
But this whole banking idea is probably more short, midterm type strategy. When we do get into, let's call it our 60s or whatever, the R word, retirement, whatever that looks like, we can start producing income from this policy without the intention of ever paying any of that money back. And we can just figure out how much money can I take out each year until I die, and then just let the ever compounding cash value and death benefit take care of any of that debt that I rack up. You can almost spend the death benefit while you're alive. And the reality is you're going to squeeze out a lot more cash flow from the policy by doing that, rather than just cashing out and walking away.
It's also, I think, Brett, important to remember this is not a behavior that's new. It's not a new concept. We do this with banks every single day, using their money, or let's reverse this, them using our money and then them getting the benefit of our money. So all we're simply doing is we're saying, why don't we put that power and that opportunity back in our hands, instead of forfeiting it to institutions who are sitting in the largest cities with the most expensive real estate, hiring all the guys with the cool footballs and all the nice cars to keep convincing us that that's the way to go, right? Instead, we're taking the power back in our hands. And for entrepreneurs, this is a major way of being able to do that.
Very, very interesting. Is there you said there's an age where you kind of has the opportunity or potential to start creating income for you. Is there an age where you should start this or should not start this? What's that, Parker?
Yeah, you could do it earlier than that, because there's no 59.5 rule or 70.5, required minimum distribution on this contract. So if you want to retire in your 50s, you could do that.
So you're talking about those minimum distributions. That's relative to a standard IRA or a Roth.
Yeah, your typical qualified retirement plan.
Okay.
What about deductions? When you put money in, is that can you deduct that?
The short answer is no. The long answer is maybe, but you wouldn't want to anyways.
Okay. Well,
because we want the latter two of the three tax treatments. If we can instead put after-tax dollars in, so we can keep that money, we can tax defer all the gains, but then we have tax-free access and distributions, and then ultimately a tax-free death benefit that will blossom and be more than whatever we've put into the policy or whatever it's grown to. We don't want we don't want to put that in jeopardy by trying to get a tax deduction. On other types of insurance, that's possible. And there are some more advanced strategies where we can get a tax deduction on insurance premiums and then pay a smaller tax on it later, but that's a story for another day.
Now, this, I think we may be kind of like leading into a more complex strategy with this question. Has anybody ever done like a self-directed insurance type company where it's invested into real estate, where you have control of where that money
carry
is
over
going?
like a self-directed IRA? If you borrowed from your policy to go buy a piece of real estate, those would be two separate transactions. It would just be like,
I'm just wondering if there was, so I've got a self-directed Roth IRA, it funds an LLC. I have checkbook control over my money, basically.
Yep.
I own real estate in that. I'm just wondering if there is any ways, or has anybody ever used insurance to do this? I'm wondering if it's that captive insurance. I don't know enough about captive insurance to have a educated conversation about it, but it's just kind of like, that's that side of the room I'm running into, like in my mind now. Oh, well, what if you did that? But it sounds like there's plenty of room on the front side of this. And I'm just sitting here trying to figure out, why wouldn't somebody do this? Why wouldn't we have clients go and fund these policies and then borrow from them? Yes, bank accounts, and borrow from them. Because if we're implementing the BRRRR strategy, where we're buying it, we're renovating, we're getting it rented up, and then we're refinancing it, leveraging out, why wouldn't we do this? Where's the downfall? Where's the downside?
Yeah, I'll tell you why. There's two main reasons I would not do this or recommend it for somebody. One is the time commitment. I need to plan on funding this for at least 5 to 7 years. Again, there are advanced strategies where we can shorten the curve, but on a typical person starting this for the first time, 5 to 7 years, more like the 7-year time frame is that ideal time frame that we need to at least plan on paying some form of premium. It doesn't necessarily mean we have to max out the contract, but I need to know that, hey, I'm committing to pay premiums for at least several years here. The other reason I wouldn't recommend it is if somebody's not okay with a small loss of liquidity up front. If I put $100,000 into this policy first year, I don't have $100,000 I can pull back out tomorrow to go invest or go finance a Maserati, right? There are insurance costs. That's why this works, is because it is a life insurance contract, not an investment. And so we need to understand that the way that we can design policies now, we can cut out most of the cost, fees, and commissions that typical agents earn on these plans and stuff a whole bunch of cash on top of the policy. But there is a limit to what we can put on a per policy basis. I should say a per person and a per policy basis. Because the premium that we can put into a policy is based on our age, health, gender, and how much insurance that we have. So the bigger the policy we have, the more money we can put into it, but the more money that we need to put into it to maintain the plan at the same time. So when we're designing these plans, instead of thinking of it like insurance and saying, well, what does a $250,000 plan look like? What does a $500,000 policy look like? What about $1 million policy? We don't even know if you need or want that much insurance. And frankly, most of the people I work with don't want life insurance, but they'll really appreciate it later. And they appreciate what it does for them. And so instead, look at it as more of a supercharged savings account and how much we're contributing on a regular basis, or how much we have in cash or assets on hand that we can then reposition and repurpose into the insurance bucket to then redeploy back into investments like real estate, which what you guys are doing. So if we can go through this on maybe a follow-up call, because so we can walk through some of these numbers. But the first 2 years, when a policy is done correctly, they're actually very inexpensive. Roughly 1 to 2% of the total account value comes out in cost when it's done correctly, as opposed to like a traditional investment where you're paying 1 to 2% on the whole pot every single year or quarterly. The problem with that is most of it's front loaded. So those first 2 years of the policy is where most of the front loaded costs and charges of insurance are. That's why we're giving up some liquidity earlier on for that money will come back to us, but we do have to at least pay for the insurance to get started and create the space to dump all this cash and liquidity in that we can then borrow back out.
Okay. So hypothetically speaking, I know we can look at this on another call and run a full scenario on something, but if somebody were to build to say that 250 pocket and it takes 7 years to fund, is it equally divided in those 7 years to fund that policy?
It could be if they're maxing it out. So, pretty commonly we'll see 50 grand a year for 7 or 8 years would be like a max funded policy. It could be 100 grand a year. It could be 25 grand a year. And think of that as the maximum. So they can do up to that 50 grand a year, but maybe it's like 10 grand a year is what they need to do. And there's some flexibility there on 1 year versus the next where they can skip or reduce or catch up extra that they may have missed.
It's also not uncommon for people to get what they need at the point of their life that they're in right now, and then be adding to that as their life or their business or their plans evolve. So it's not uncommon to see somebody like Parker who might have a dozen policies or close to, because he's evolved over time with what he plans on doing and what his needs are. And the other thing that's important to note as well is the more income you make, although your health may adjust with age, if you're especially getting this within a window of time where it's not varying by that much, you actually may, the more money you make, qualify to get more insurance because you're more insurable based on those things as well. So all of that is taken into account also.
Okay.
Just to clarify, I don't have a dozen policies. I only have 9.
9. That's very interesting.
And I know we're starting to get into the weeds, but hopefully this was at least good, high level. I know we went a little deeper on some concepts, but was there any more kind of high level or?
I do have a very interesting question. Thank you for your time, first of all, and the experience and your guys' knowledge is remarkable when it comes to this. So I just love running around the room, bumping into the walls, asking these questions. I've got I know somebody that actually funds life insurance for baby family members.
Uh-huh. That was my 9th policy on my 2-year-old.
Yeah. So what are the benefits of that?
Second policy.
And what, I guess, how does that grow? What does that look like at a high level?
Yeah. So again, this is always where it, just depends on what the client looks like. What does the situation look like for mom and dad? How much insurance do they already have? If dad comes in and he's got a $50,000 group term plan from work and he's trying to put $1 million policy on little Sally, the insurance company is going to raise one of the red flags and go, nice try, buddy. However, if we do have, insurance companies aren't looking at how we want to use the policy. They're looking at it from a risk perspective, right? So the death benefit and the insurance amounts have to line up with who the client is. Is there, an insurable need or risk, or what would be the financial loss if somebody, something were to happen here, based on who's paying for it, who the insured is, and then ultimately who the beneficiary of the death benefit is. So yeah, absolutely. You can do kid policies. I love doing kid policies. That ties into some of our, business planning and tax strategy as well. That's pretty cool, where Thomas, that tax deduction on the premium, we can circle back on that. But on kids under the age of 16, they're not fully underwritten plans, so there's no medical exam. It's just kind of pass or fail, standard ratings for kids. So even though they're, as super young and cost of insurance is low, there's not as much customization, and the policies don't get as efficient as quick as they do in a plan like a full-grown adult would have. And it's not until you get into this question revolves around, like, am I too old for a policy if I'm doing it for kids, if I don't already have something on myself, to then spread it to them? Usually, obviously, if we're in poor health, this isn't that great of a strategy. If cost of insurance is through the roof, if we're 600 pounds, we've got one leg, cancer, and we're going to die in 12 months, then yeah, this is not going to work. But, as long as we're under, I would say late 60s, early 70s is when this starts to maybe not make sense. But most people at that time in their life probably aren't just trying to save money either. So so that the ideas change and the strategies change when we get there. But yeah, so there's a lot of different ways you can slice this. Kids is absolutely one way to do it. A spouse is another way to do it. Business partners. You can even do it on parents or even grandparents, depending on the situation. So depending on our age, what we're trying to fund a plan with, usually the primary breadwinner is the first person we'll look at. But if health or age is an issue, then that's when we can start to look at other people. Or if we're just building over time, like what I've done, over the last 10 years, I'll just continue to add more policies as I can afford it and as I can qualify for more insurance. And if I'm maxed out, then I do something for my spouse where I can get 50 to 75% of what I have on her. And then on kids, kids, you can usually do anywhere from 10 to 12 grand or roughly $1 million policy. But again, I got to have more than that to justify doing that amount of insurance on a kid, whether it's a 30-day-year-old baby, or if it's a, 18-year-old who's still living at home.
Interesting. So to kind of wrap this around, I think when we work with clients, personally, relative to real estate, I think the biggest opportunity is going to be working with the established policies. Does that sound reasonable? Because we don't have the 7-year target to take action on.
Yeah, especially when we're wanting to access larger amounts of money in a policy. We're going to be more limited on the kids, but if we as the primary breadwinner, if I'm making 3, 4, 5, 600 grand a year, I could probably put 50, 100 grand, 150 grand a year into one of these plans. And 30 days later, I can borrow out the majority of that money.
Right. Okay.
So you can access money pretty quickly, again, when it's done correctly. But we do need to plan on at least, funding it for several years to make sure that we justify and satisfy the insurance test, so that this doesn't get treated like a taxable investment.
Right. Okay. Well, very interesting. I think that is a great wraparound. Lots of general questions on leveraging insurance itself. Did talk just briefly about a velocity kind of issue, and maybe we'll save that for the next time we get together and have some more hard numbers here. Man, guys, I really appreciate it. Again, the knowledge, the experience, the time. Parker, Garrick, David, always a pleasure. Capital Impact, Thomas, throwing in some questions today. Man, just appreciate everybody and look forward to catching up with you guys again on the next one.
Sounds great.
Awesome.
Thanks,
guys. We'll send you the bill.
Awesome. Do it. You got my address. My address is in Turkey.
Or we'll just get your kid set up. We'll take that as payment as well.
There we go. All right, guys. Have a great day.
Awesome.
Thank you, guys.